Deciding whether or not to invest in a company can be really hard. So, I'm going to be sharing with you Peter Lynch's investing checklist. That's right, this legendary investor tells us exactly what key things to look for when investing. And we're covering all 6 of them in this video. Let's do it. What's going on, everybody? My name is Matthew. Welcome back to my channel, and today we are talking all things Peter Lynch's investing checklist. Step number 1 to being a great investor is to wear glasses, have white hair, and a nice comb over. Now, I know this isn't my typical video, but I wanted to bring more value to all of you than just picking stocks, and after all, this channel is about making you an independent investor and empower you to be able to do your own research. So here's a checklist that you can literally keep by your side while doing research on new companies. Give me the format. First, a very quick background on Peter Lynch himself. Why is he so legendary and why should we listen to him? Second, we'll go through each part of his checklist and elaborate on them as we go. And since today we're doing a video on his checklist, let me know in the comments below if you want a second follow-up video on Peter Lynch's rules for investing. Alright, no time wasted, let's get right into part 1 of this video. Who is Peter Lynch? In 1977, this guy took over Fidelity's Magellan fund, which at the time had $20 million in assets under management. But by the time he left in 1990, it had $14 billion in assets under management. After 13 years of running the fund, Lynch would go on to post a massive 29.2% annualized return, which at the time was double what the S&P 500 was earning. The Magellan Fund was without a doubt one of the best performing mutual funds in history while under Lynch's management. And let's quickly put this in perspective. A study from 2019 showed that in the past year, 64.5% of large cap funds underperformed the market. And that's just 1 year. That's a relatively short time frame in long-term investing. Over 10 years, even less beat the market, with 85.1% underperforming, and over 15 years, more than 90% of large cap funds lagged the market. Again, Lynch doubled the S&P 500's returns over 13 years. He's also credited with pioneering the price to earnings and growth investment strategy, also known as the PEG ratio, which helps value a stock similarly to the PE ratio, but also accounts for future expected growth. And lastly, he's a firm believer that retail investors like you and me, we can beat the big guys. And here's an idea how. Let's talk about part 2, Peter Lynch's investment checklist. Now, I didn't put these in any particular order of importance, but let's get started with number 1, check institutional ownership. And Mr. Lynch says, in regard to institutional ownership, the lower, the better. And institutions, to put it simply, are the big guys. They're the large entities that help manage money for others, like banks, pension funds, and investment firms. And the reason why Lynch says it might be better for institutional ownership to be low is because if institutional ownership is high, then it's more likely the stock is overvalued. 1, because institutions control so much money, if they've entered a stock, it's likely that they've bid up the price significantly since entering. After all, institutions own over 2/3 of the stock market. And 2, banks have analysts covering the stocks that they're invested in. And positive press from analysts can sway more people to invest in that stock. For example, if you saw something like this, then you might want to consider buying Amazon. And as more people follow analysts, there's just less value to be found. And that's why low institutional ownership means more value to be found. Checklist item number 2 is check the PE ratio. Is it high or low for this particular company and for similar companies in the same industry? Whether you're a new investor or a market veteran, you've almost certainly heard of the PE ratio. It is simply calculated by dividing market cap by a company's net earnings, or stock price per share by earnings per share, which is essentially the same thing. A PE ratio is usually a quick and easy way to just generally understand if a company is overvalued, undervalued, or priced just right by comparing it to its own historical PE ratios and by the PE ratios of similar companies within the same industry, just like the quote said. A lower relative PE usually indicates that a company may be undervalued, but always remember that you probably shouldn't base your entire thesis on a stock just based on this one metric. Number 3 is to check to make sure you smash that like button. If I got you, you know what you have to do. But really, if you are finding some value in this video, I'd really appreciate just a little thumbs up. It helps out a ton. Thanks so much. You should actually be checking for insider activity. Whether insiders are buying and whether the company itself is buying back its own shares. Both are positive signs. If the company is buying back its own shares, or if insiders like CEOs and directors are buying shares of their own company, that is usually a very good sign. We could even take our quote game up another level by whipping this one out. Insiders might sell their shares for any number of reasons, like to buy a mansion or a Lambo or whatever rich people buy. But they buy shares for only one reason: they think the price will rise. I actually mentioned this exact quote in one of my previous videos covering Maxar Technologies. Their CEO, Daniel Turnaround Beast Jablonski, bought 3,000 shares of Maxar on September 1st for $22.69 per share. And it looks like Big Dan was right about something, because Maxar's up over 22% since September 1st, and I ended up adding to my position soon after hearing this news. And big shout out to the Discord for bringing this one to our attention. If you don't already know, Discord is where I share my buy-sell alerts and where we have an intimate community of like-minded investors. So definitely check that out in the first link in the description if you think you'd find value there. Okay, I'm done selling out. Let's move on to number 4, earnings growth. My buddy Pete says to check the record of earnings growth to date, whether the earnings are sporadic or consistent. The way I see it, earnings, or the potential for earnings, is really what drives stock price, because after all, the more earnings, the more valuable the company. Just be wary, because earnings manipulation is certainly a thing in the public markets, but don't worry, the SEC is doing its best to get your back. To get back on topic, consistent and predictable earnings growth is certainly a plus, but I always try and make sure to check other metrics as well, such as free cash flow and many others. Number 5, and the second to last thing to check, is their balance sheet strength. Check if it is a strong balance sheet or a weak balance sheet, for example, by checking the debt to equity ratio and how it's rated for financial strength. Whenever I analyze a balance sheet on this channel, I usually just cover the big things like cash on hand, current ratio, liabilities and debts, or any line items that I think are unique or important to point out. But the debt to equity ratio is just calculated by dividing total liabilities by total shareholder equity, and these can both be found on a company's balance sheet. And I know what you might be thinking now: to find the balance sheet for a company, just type in XYZ Company Investor Relations and click on their quarterly or annual reports. The debt to equity ratio is really just a way to get an idea of how much a company's financing is through debt and how much of the financing is wholly owned. And it varies by industry, because different types of businesses require different levels of debt, but a general consensus says that debt to equity ratios usually shouldn't stray too far above 2, because the higher it is, that means the more debt, the more leverage, and usually the more risk to your investment. And finally, checklist item number 6, the cash position. This is a nice, easy, fast one to end on. The cash position is the floor for the stock. It's as simple as that. And that simply means if a company has $1 million in cash, then the market value, or the value of that company, should not go below $1 million, because they have that in cash. I'm not quite sure how to explain this more simply. It's kind of like $1 should not be worth any less than $1. So in looking at a company, you can check their cash position, and that should be the minimum valuation for a stock, even in the most dire circumstances. So those are just 6 parts of Peter Lynch's investment checklist, the man who averaged 29.2% over 13 years. Let me know in the comments below if you want a follow-up video on Peter Lynch's rules for investing, and I'll definitely make sure to make that for you. And by the way, Peter Lynch wrote a great book for any retail investor called One Up on Wall Street. I actually just bought it myself, and I have an affiliate link down in the description below if you'd like to check that out. It would help support the channel, and you can learn a lot more about this investing legend. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and check out the quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And if you're watching at this point in the video, you are the real MVPs. Don't forget, peace and thank yous.